All right. Once again, thank you everyone for joining, and I want to say thank you to our speakers today as well, because we believe that our conversation is going to be a rich one. And before I go on to introduce our speakers, I just want to do a quick housekeeping. I think Pedro already did that as well. That is, if you at any point you have questions, you can drop in the chat at the end of the webinar. We're going to take towards the end. We're going to take the questions accordingly. Yeah. So let me go straight now to introduce our speakers. For today, we have 4 speakers, and each of the speakers are unique in their sense, considering their backgrounds and their expertise. So, and I trust that they're going to bring that uniqueness to this discussion for us, and we're going to learn quite a lot of things today. So the our first speaker is Maciej Kowalczyk. Maciej Kowalczyk is a seasoned expert in portfolio investments, market risk, fintech, and data analysis. With extensive experience in financial risk management, he has worked with leading global institutions, including Citigroup, where he specialized in market risk and counterparty credit risk simulation models, and the Royal Bank of Scotland, where he focused on derivatives, quantitative controls. Maciej co-led a fintech company that delivered cutting-edge risk analytics and investment management software for asset managers. He also worked with top consulting firms such as Accenture and PwC, leading risk system implementations and model development projects. In addition, he has provided strategic guidance to fintech startups, leveraging his expertise in data analysis and AI and ML. A CFA charter holder and also a certified financial risk manager, that is FRM. Maciej shares his knowledge as a lecturer at Kosminski University, where he teaches postgraduate courses on derivatives. He has also conducted numerous training sessions on quantitative finance, risk regulation, and alternative data analysis. Our next speaker is Pedro Feliciano, CFA. Pedro has over 15 years of experience. Pedro started his career as a tax consultant at PwC from 2008 to 2011. Then he joined Absolute Meters, a small investment advisory company, from 2011 to 2014. He currently works as a senior investment advisor at LM Capital Wealth Management. In addition, he has been a trainer in machine learning and Python programming at Instituto de Formação Bancária since 2017. He studied management and data science for finance and has been a CFA charter holder since 2015. Our next speaker is Alejandro Bermúdez. Alejandro Bermúdez is a seasoned civil engineer and real estate strategist with extensive experience across Europe and the United States. A graduate of the Polytechnic University of Madrid, he began his career at IL International, managing building renovation projects in Germany and Spain. He later expanded his expertise at Urbania International, where he played a key role in overseeing large-scale student housing development. As a co-founder of Atlas Real Estate Analytics and Fragro Analytics Software, Alejandro now advises investment funds, banks, and developers on real estate strategies, leveraging data-driven insight to optimize investment and development projects. Then we also have Claire Tang. Claire Tang is a CFA charter holder with a master's in sustainable finance from EDEC Business School in France. Since graduating, she has been working as a customer quant at Wifin, where she analyzes ESG data, calculates ESG metrics, and produces ESG report to support sustainability-focused financial decision-making. All right. So now we're going to start with the questions for our speakers today. And like I said, I want everyone to mute so that we don't get the distraction. And I'll start with Maciej today. He's going to start with the, he's going to start to open us up on a number of things regarding data science as it applies to his expertise and risks and portfolio management. So Maciej, I'm going to ask this. Given your experience in risks and portfolio management, how has data science enhanced automation for financial institutions and improved decision making?
Thank you, Tosin. And first of all, thank you for having me. And let me say hello, hola, hola, salut, muy bien to everyone, and dzień dobry. So basically, as probably we all know, there is a abundance of applications in areas where data science, algorithms, and quantitative models in general, in a wider sense, enhance automation for financial institutions and asset managers in particular. So just for my benefit, please allow me to focus on a range of my experiences I believe encompassing both simpler and more complex techniques and applications. So I might start with with the efficient big data processing for simulation model backtesting that I did for while cooperating with the Citibank. I was working as an external consultant, and we were responsible for supporting risk modeling analytics quant team and the counterparty credit risk measures market simulation model development for different asset classes. But basically, the example I want to talk about is the FX derivatives. And we were handling the model backtesting and sensitivity analysis as part of the revalidation of a simulation model, and basically involved performing complex data transformations and multiple simulations on the vast amounts of data. So just to give you the sense of scale, it was population between 100 and 500,000 trades for each date, which translated to between 50 to 90 gigabytes of data for a single date. So it was more about handling this amounts of data to make it bearable, and we had to optimize the process, obviously by employing a combination of Bash and Python programming languages, employing parallel processing in order to improve efficiency, in order to make it bearable at all. In fact, a fun fact was that at one point I got even too efficient, because we successfully managed to max out a CPU cores on one of the shared servers, accidentally disrupting critical day reporting. So just a gentle reminder that even automation needs some risk management. Other examples I was working with that are worth mentioning is obviously such things like alternative data usage, predictive analytics. So as you know, data science is one of the enablers of wider usage of alternative data to gain a competitive edge for investment managers. I was briefly cooperating with one of the small startups on POC of using natural language processing model to perform sentiment analysis based on investment firm discussions, and as well as harnessing transactional data from a local e-commerce platform to predict revenues of that platform, and also inflation trends, which was a major issue at many European economies, especially in the recent years. And so obviously the other thing and the last thing I would like to mention is the building high performance quantitative model engine. So back at the fintech I was working for, we were by leveraging big data tools like NoSQL database, which was Cassandra in our case, functional parallel computing friendly programming language, which was Scala, and containerized environment, we build a resilient, high-performance calculation engine for calculating market risk measures in a matter of milliseconds to seconds, depending on the complexity of the models. So these are like just few examples that I might mention based on my recent experiences.
I see from what you've said, that's a lot of technical expertise there. Yeah, from what you said. Yeah. All right. So we're going to move towards more private wealth management. Pedro, can you shed light on how AI and machine learning are being used to create tailored investment strategies for high net worth individuals? Because I saw that you provide consulting and strategies to help your high net worth clients as regard your portfolio. Can you tell us how AI and machine learning are being used to create tailored investment strategies for them?
Yes, Tosin. Yes, and thank you very much. Let me also say thank you for inviting me for this session. What I think AI allows AI and machine learning, and also data science, because data science is not just AI and machine learning. Some traditional statistical techniques are also included in this data science field. But I mean, AI and machine learning allow us automation of processes and also personalization. So I think that, of course, analyzing alternative data to generate new signals and insights from market data allow us to develop new strategies for our clients. Yes, using unstructured data, like the previous participant said, unstructured data like text, image, etc. And not only alternative data that is available for everybody, but also some unique data sets that, for example, a big bank can use, and it's their own unique data from transactions from their own book or from their own clients. And they can use that unique and alternative data to generate their own market signals and have a competitive edge analyzing markets. But let me add that automation plus personalization of a portfolio allow banks or asset managers or wealth managers like our company to provide a good service, not to the high net worth individuals that have more than 5 million or 10 million portfolio, but also for lower tier clients, clients with a net worth that is lower, but also can benefit from this kind of personalized approach, because if processes are automated, we can provide with a much better service to lower tier clients. And that's those are the things I understand that add value and add some personalization to clients' portfolios. Then I can also share a project we had here. Of course, we also do some personalized portfolio management for some clients. And the first thing to do was to try to organize our clients in clusters, so that when we were trying to do some kind of recommendation, if it is suitable for a client, probably it will be suitable also for the clients of the same cluster. And that's one of the projects that we have done here.
Right. Thank you, Pedro. Thank you. Yeah, so but I should be going over to Alejandro now. But before I go to Alejandro, I want to go back to Maciej. Maciej, when you were talking earlier on, you mentioned the fact that you use sentiment analysis. Can you throw more light on how you use sentiment analysis in a bid to provide consulting to your clients in terms of what you do? Just shed more light around it.
Sure. So basically, it was the employment of the natural language processing model So we took the data from investment forum discussions regarding the stock market, and based on based on those discussions, we created the certain type of the index, sentiment index, which we were planning to use as the predictive indicator of the stock performance, on the rate of return of the performance. And we had some promising results there. As I mentioned, it was just POC, but with the promising results, with the proper fine tuning, there is a lot of value to extract there, depending on the data source, depending on the obviously the data quality, which I know we will be covering in a minute. So so that was one of the examples of where it can be used.
All right, thank you very much. Yeah. Now our next question is going to Alejandro, who is more who has more expertise in real estate. Alejandro, I will be asking you this right now. Data-driven decision making is rapidly transforming real estate analytics. What are some of the key trends you've seen in real estate investments using AI?
So first of all, thank you for having me here. And it's a very good question. I'm seeing my partners, my colleagues here are doing very, very good AI applications. So first of all, I have to give some context because, as my colleague said, AI is something that has been since a long time ago in the real estate sector. So AI was not created by ChatGPT, let's say. So we have had in the real estate sector from since, let's say, 10 to 15 years ago, we've already had some AI applications. The very first one was usually evaluations. So automatic valuations of portfolios, REOs, non-performing loans, and then let's say automatic valuations for as a B2C market. And then the second one is forecasting. So when I mean forecasting, I say, of course, seeing the future, trying to forecast some KPIs to the future, but also fulfilling time series which are not completely perfect. So they lack some data in the past. And then when we are monitoring this, we not only can forecast the future, but we can correlate automatically some KPIs, some metrics between them. So we can correlate the prices, the demand, the household income. We can correlate the population growth. We can correlate the birth rate. So we can do correlations for, let's say, any kind of metric, which is kind of complicated. So we can do that. And the AI is able to do even automatic combinations. So of course, there's easy things to see. So for example, one of these is like, we were the first one to see that the effort rates are dramatically growing in Spain. So I'm sure it is pretty much similar throughout the whole Europe, but supply of real estate houses for sale and rent is going down. Prices are going up because of inflation and even higher than inflation. So what this enables you to see the active monitoring of the data enables you to see that the effort rates are growing. And this means that the AI is able to correlate with KPIs. So we are already starting to see that some areas are kind of plateauing. So some areas in specific cities, instead of keep growing the price and the supply going down, we see some areas in which the prices are plateauing because the effort rates are so high that the demand in the area cannot afford to buy more houses. So the AI, for example, is able to tell us what do these places have in common. So in a specific part in Madrid, or in a specific neighborhood in Barcelona, Malaga, or even in Paris, or even in London, or maybe in Coimbra. So we can see what are the metrics that explain the areas that first plateau, and then what areas do we expect to have this effect, or maybe even if these areas that are plateauing right now, maybe the price is going down in the future. So this is very interesting for investors. So forecasting is a very good tool for real estate investors that are thinking on financial assets such as build to rent, flex living, senior living. So you are thinking on a 5 to 10 year period. for you to get the results of your investment. But then we have to think about that all these KPIs can be correlated with other things that have to do with AI in the real estate sector. For example, urban planning, urban regulations. So urban regulations in the most of Europe, if we exclude the UK, are kind of complicated. They usually are old-fashioned documents in PDFs or even written by hand. So all these text, I think one of my colleagues said before, text recognition. So we can use text recognition and then AI to digitalize and to learn about the urban regulations. So we can make forecasts about, okay, what's the predicted amount of houses we will be able to build in Spain or in a specific city within the next 30 years. So are the urban regulations allowing to build 1,000, 3,000 buildings, houses per year in this specific area of Malaga or not? So we can, through this process of data sourcing, we can enrich our forecasts and our trend analysis. So that's giving us a very complex and rich and insightful KPIs and insightful conclusions for the investors, because here in let's say Iberia, because sometimes the investors from the UK, America, they say Iberia, they don't say Spain or Portugal, they say Iberia. So most of them, they don't know the micro trends. So we can help them to see these microtrends. Okay, what are the areas that lack most of the housing? Which areas are plateauing? Which areas will plateau? Which areas still have room to grow? So one of the main issues here is that we see is that the effort rates, the liquidity is going down in specific areas. We also analyze very deeply. In Portugal, the problem is exactly the same. The vacational rents. What kind of impact do they have in pricing and supply? They have a huge impact in supply. It's not pretty clear they have a direct effect in pricing, but they do have in supply. So, and then, for example, other trends that we see is that these price limitations throughout Europe, Berlin, Barcelona, Spain, what's the effect? What's the actual effect of these price limitations? So that's something we can of course monitor. And then one of my colleagues said sentiment analysis. This is very interesting because doing clusters and then through customer success through AI, you can also extract insights from not only from the social networks or surveys, but from tenants of the assets. So if you're a portfolio manager, you have 3,000 homes, then you have at least 3,000 tenants. So with if you have a proper customer success or customer management platform, you're retrieving constant data, which is very good to be analyzed. So that's a huge potential of data we are getting right now, but we are analyzing it, but we still don't have time to analyze all the data we are ingesting or our clients are ingesting. So the possibilities and the chances in the future are growing.
All right, thank you. So we go over to Claire. Claire is more into ESG analytics. Claire, why should investment professional integrate ESG data into their investment decision? Can you tell us that?
Yes, thanks, Roland. Thanks for having me. Yeah, so speaking of the reasons why investment professionals should integrate ESG data into their investment decisions, I do believe there are quite a lot of reasons. But if I just pick up 2 or 3 here, I would say the first reason is that they need to manage risk, and the risk led by climate change. Climate change is happening now, and and events like flooding and heat waves, they are more and more intense and more frequent. And those climate risks, they will eventually translate into financial risks, and those events will eventually influence the financial statements of everyone, not just investors, but also companies and even individuals. And for example, for real estate industry, which Alejandro just introduced, I do believe climate risk is quite a big risk for real estate industry. And the second one, I would say it's about regulation. So it's another risk, regulation risk. And the regions where regulations related to ESG are more standard, investors in these regions, they are more aware of integrating ESG data. For example, most recently, I saw a survey made by International Valuation Standards Council. The survey shows that European investors show higher level of ESG integration into valuation process compared to those from other regions, for example, United States. And last but not least, I think there are more demands from end investors. It's just investors, they are more and more aware of integrating ESG factors into their asset picking. So they are asking investment professionals to consider these factors.
All right, thank you, Claire. And now, Maciej, I'm coming over to you again with the next question that focuses more on the challenges. Okay, so one of the most significant challenges in financial automation is data reliability and model accuracy. How do financial institutions ensure that AI-driven investment models remain accurate and unbiased?
Yeah, thank you for that question. I would argue that good quality AI models share the same prerequisites as traditional models, namely four important factors. So ensuring data quality, robust model development and model validation processes, as well as final stage of proper model implementation. So for development and validation, we're talking about extensive model testing, including backtesting, sensitivity analysis, stress testing, as well as more qualitative assessment, like, for instance, fit for purpose. Because we need to be aware that every model, and including AI models, LLMs, any more traditional models, they have their limitations, pros and cons. And applying a model for a proper purpose, where it can bring value, is a key to success. And I will personally argue that it is more important for the model to be useful than accurate, which might be not popular, but this was the case in many back in history for many models, and I guess to some extent it still will be, especially when you're looking at the LLMs, where people tend to use them massively, and while they're, for instance, they're wildly hallucinating. So I mean, we know they're not accurate in many instances, but that doesn't make them not useful for certain purposes. It's just a matter of knowing what purpose is the best one. And obviously AI and ML models have additional challenge, like explainability, which is one of like the key things for financial institutions, not only for regulatory purposes, because usually when the model outcomes are undesired, you are with the traditional models, you're able to go back to trace the root cause of the problem. Either it lies in the data model itself or its implementation, basically. And obviously with AI ML models, it might be more difficult. And probably this is one of the reasons why large banks have this factor as a requirement for AI ML model development, so that you, in the development phase, you include and make sure that the model to some extent will be explainable. Obviously, this is an evolving thing, evolving field, and interesting one, which we can expect a lot of developments in the future. In that, there are techniques like partial dependence plots, explainable boosting machines, like Shapley additive explanations that might be explored for different use cases. However, I cannot stress enough the importance of data quality, because this is was something that the factor was major cause of models output quality, bad quality throughout my career, and it's still prevailing. And for instance, large institution that I was working for, in my opinion, they had a robust model development and validation processes, but suffered from poor data quality. I mean, on the basic level, because I was working with some equity time series, like very basic one, and it has some missing data points to the level that Yahoo Finance got better quality. When you're working with one of the largest investment banks, you would explain some of the basic quality to be there, and not mentioning, you know, some of the alternative data sets we're discussing here, right? And this is like, you know, basic time series. Another example was like the commodity derivatives data series. So bank had two different systems with different data source selection and continuous series construction logic, overlapping data sources, and no consistent policy in which system to use. And basically there was like another project in which I was involved, in which we had to analyze massive amounts of data just to check which system is better, because they had a different logic of amounting the data, and then those data was used for different applications like covariance matrix calculation purposes. And that's why I believe that the data remediation remains crucial, especially when employing AI models, because they depend heavily on high quality data. And as we know, these these models are more challenging in financial world in general, because we have little data, because of the data quality issues. But fortunately, just to sum up, AI models can help address these very issues that they're suffering from, because we can improve data quality using through detection and filling gaps using AI models, or, which is quite popular and interesting application, generating more simulated data. Since we don't have enough of historical data, we might simulate one. Obviously, this creates another class of problems, but helps with this one.
All right, thank you. Over to you, Pedro. The challenge in balancing AI-driven insights with personalized human advisory. How do you see AI complementing traditional wealth management rather than replacing it?
Yes, well, private wealth management is a relationship business. You need to have your clients' trust so that you can develop a good relationship. So I think, yes, it's AI. It's complementary to what human advisors do. We need to have data science to analyze all the data we can to generate better insights in terms of investment insights, and to have great investment advice. Yes, that's for sure. But when stress hits the market, clients like to have a person to whom they can discuss, to whom they can ask questions, and to whom they search for some advice for the future and to take decisions. I think if markets are going well, everything is in a bull market, etc. There is not much need of a financial advisor. You need a financial advisor to help you get through the difficult moments of markets. And so I think AI should be viewed as a decision augmentation tool, should help advisors formulate good investment decisions, but should not replace a person to help high net worth individuals to make investment decisions. I think that's for sure. So for all the people that is listening and that would like to be a private wealth manager, I would say, okay, your job is not at risk, because people will be needed to make the job, but you definitely need to have some training and some courses in data science, artificial intelligence, and machine learning, for sure.
Right. Thank you for bringing that hope to kind of encourage as many who might be thinking their job is at risk. Yeah. All right. So over to Alejandro. Real estate markets involve numerous unpredictable variables. How do AI improve real estate forecasting and mitigate investment risk?
Okay, so thank you for the question. So Maciej did a very interesting speech before, talking about the data quality and talking about the completeness of the data. I will use this basis because the real estate sector seems to be a sector in which we have a lot of data, but this data is usually not a very good quality one, and it is not mergeable. So what I mean is that, for example, we have demographic KPIs, which we obtain from public sources. And this problem is for the whole world. So there's no country which has perfect data. And then, for example, the household income analysis comes in a yearly basis. And depending on the country, it comes in a province basis. Then we have to merge it with listing information from the platforms, which is a coordinate system. And we have it 5 times per day. Then we have data about the land registry, which is updated once every 6 months. Then we have data from, for example, if we are analyzing the hotel market, we have dynamic pricing, which updates in real time. So we have very, very different sources of data that come from very, very different sources of information. And then all these sources are usually not reliable. So if we do analyze, for example, the public sources, sometimes you see shady things. So like strange jumps in the data, strange patterns that do not meet reality. So the first thing that AI can improve is, as Maciej said, to improve the data quality. To search for these anomalies, these outliers. But then when we imagine we are able to homogenize all this information, how we can do that? So for example, we can do that with AI. So if we get information in a huge geographical basis and we need to reduce it down, we can do it through AI, which is a kind of forecasting. Instead of time series forecasting, is like a geographical forecasting, because we can forecast a specific KPI for specific areas, given a bigger data point. So, and then imagine we have everything for the same time aggregation, the same geographic aggregation. If we have that, all the data sources and all the KPIs we have, they go way beyond the human capabilities of analyzing. So we could have thousands of KPIs generating in real time in the real estate sector. And then we are analyzing real-time data for a sector which works in annual or even 2 or 3 years granularity. So because when you start a project, this project is going to be built within 1, 2, 3, or 4 years. No? So AI is able to analyze all these KPIs together that go beyond human capabilities, because we have hundreds of them. So that means millions of combinations, and extract the best patterns. Okay, so AI with better training is able to do better forecasts. It is able to generate better analysis, and it is even able to learn from reality. So if we, for example, correlate the information obtained by a forecasting model, let's imagine a high quality, high frequency asset, a hotel. So if we are feeding real time our forecasts with the actual operating data of one hotel or 100 hotels, imagine we are working for Hilton, for example. They have thousands of hotels around the world. So the algorithm of AI can learn in real time with real time and real data, so it can improve its predictions. Okay, ADR predictions, occupancy predictions. It can correlate them with the price of the flights. It can correlate them with the tourist information. It can correlate them with Google Trends. So the amount of information is huge. So that can only be used through AI, because it's beyond human capabilities. Okay, so and of course, if we improve forecasting, we improve investment risks. So for example, as I said before, areas that are plateauing and are likely to go down. So supply is starting to accumulate, prices are starting to go down, the landlords are becoming tense because the liquidity is going down, so they have to sell the properties. And all these kind of things are predictable, and we can reduce the amount of mistakes through AI. And that's why we founded our company, because usually real estate sector and all the sectors in the world, not only real estate, but finance, etc., there's an investment through gut feeling. And gut feeling is essential, but sometimes it leads to mistakes. So that's why we created our company, to reduce these mistakes and to complement the gut feeling. So your gut feeling can be informed. So that's how I think AI is improving forecasting and, of course, reducing risks.
Yeah, thank you. I love the fact that you said it improve forecasting, and also that also impacts the improvements in investment rates. Yeah. So over to you, Claire. What are the challenges in integrating ESG data into traditional investments, and how do we overcome such challenges?
Yes. So about challenges of ESG data, I think those challenges are still like on the basic level, like collecting level and processing level. For example, the first, maybe the most, the biggest challenge of integrating ESG data is that we do not even have standardized ESG metrics yet. And for example, like there are several big data providers, for example, MSCI and Sustainalytics. They are two big ESG data providers. And even for the most basic ESG metric, for example, GHG emission, and they have different methodology to calculate this basic metric. And for other metrics, they of course have even more different ways to calculate them. So and this just brings to another challenge. There are a lot of data providers on ESG data, which may be a good thing. On the one hand, it's a good thing to have a lot of data points that data providers, but on the other hand, it's very difficult to compare data. It's like what Alejandro said, those data are not really mergeable. You cannot just take one metric from data provider A and compare it to another metric to data provider B. And so this is another challenge. And the last but not least, it's very difficult to audit ESG data. It's not like financial data. We have already a standards to make financial data, to publish financial reports. But in ESG, we still do not have standards to publish, first of all, publish ESG data. And secondly, we do not know how to really fairly audit those ESG data. So it's very difficult to believe which data you should take and integrate that into your evaluation process. And speaking of how to avoid them, although we still do not have a standardization, but I believe regulators and also big data providers are working on the track to achieve the standardization of ESG metrics. And also, apart from that, enhanced professional development is a way to enhance the integration of ESG data and how to learn to collect and process those data, and with the help of data science.
All right, thank you very much. Yeah. So right now, our time is fast spent. We have a question that is more generic for all the speakers, and that is, what are the next big trends in data science that would shape investments in the next 5 to 10 years? So I want you to touch on it quick, so that we can also be in time. Yeah, I will start with you, Maciej. Yeah.
Sure, thank you. So I guess I'll mention just two things, and one in the short term is basically just the further automation of processes, also like wider range of processes, because now we have more capabilities to automate something that wasn't possible like 10 years ago. But basically, you know, from the AI handbook, that the consensus is that we should rely on a hybrid approach, combining AI and HI, human intelligence. And I guess there's a good analogy to chess, where Gary Kasparov stated that mediocre player equipped with the well-performing AI system are able to beat top players or top systems playing alone. which I guess this might might be the case also for financial industry investment management in particular. With the climate management fees, in my opinion, the success depends on efficiently combining investment expertise with those advanced tools and automation. And the most exciting development for me is the fusion of quant ML techniques and AI agents of like LLM class models to enhance both alpha generation and process efficiency in general. And this is something that, you know, there are some things happening in that area, some firms trying to employ those both types of models. And the other one in the longer term, so I would say like 5 to 10 years, I'm watching closely quantum computing, though it's in its infancy. I guess, you know, it might be really revolutionizing for solving complex problems and process large data sets when it comes to speed. And as we know, especially for top banks and top investment firms, the processing speed is quite important. We know it's not going to be useful for all the use cases, but for certain use cases, it might be a game changer.
All right, thank you. Over to you, Pedro. Yeah.
Yes, thank you. So what I think will be the next 5 to 10 years, we will see many AI assistants helping investment advisors and private wealth managers with the most repetitive tasks, something that don't add much value, like compliance, know your client processes, etc. Try to automate all those tasks so that advisors can have face-to-face meetings with clients, trying to build trust with them, etc. And then about alternative data, I think alternative data will start to be a must-have instead of a nice-to-have, or instead of generating some kind of edge. So the thing will be, if you don't use alternative data, you will not be playing the game, instead of adding you some kind of competitive edge. And the last thing, which also I think other speakers addressed, is regarding explainability. Regulators don't like black box models that they cannot understand the relationship between the input and output. So I think we will see developments in explainable AI, because as Maciej also touched on it, you can use AI to try to address these relationships between inputs and outputs and try to understand why the model is suggesting that decision instead of the other. So I think those are the things that will shape the next 5 to 10 years in my area.
All right, thank you. Alejandro, can you say something before we move to Claire? Yeah.
Of course. So for me, the AI is going to impact the real estate sector in each one of the steps. So from underwriting, so opportunity sourcing, automatic opportunity sourcing through, let's say, image recognition from satellites, from urban planning, merging all this data, automatic enrichment of underwritings. So data of the absorption, supply, demand, comparables, price trends, etc. To design. For example, we are seeing right now the very first startups that are able to design a building from scratch in seconds. So you give the land plot, and then with the urban regulations of the area, they design the best possible building, meeting all the regulations, and then maximizing the area usage. So, and they design it within seconds, testing not only 2 or 3 possibilities, but thousands of possibilities. So this is removing the use of designers, architects, etc. I will say not removing. I will say that this is making the architects to create added value instead of designing parking lots. Okay, so no architect likes to design parking lots. So this is something that can be automated. It will construction, for example, industrialized construction. So in order to achieve proper industrialized construction, so either you sell a specific house like they do in Japan. So they have the house type A, the house type B, and then they sell these houses. Or if you want to adapt to a land plot, which is something you have to do in Europe, you will have to use AI to calculate the number of pieces that the building needs to be built, and then to minimize the different number of pieces. So this is industrialized construction. So instead of going then brick and mortar, you will be able to pre-design pieces on a factory with very good working conditions, temperature, no rain, etc. And then you will be able to ensemble the building on site. And then, of course, property management and selling of the building. So property management, we've already seen. ESG, client success, client management, maintenance, predictive maintenance. So when do I have to send the technician to prefix the HVAC, etc. So the applications of AI will be huge. Some of them are immediate, such as the automatic design. Some of them require the industry to be aligned, such as the automatic construction. But of course, we are also seeing VR to sell the houses, automatic design of not only of the shape, but the design. So you can prompt, I would like to design a neoclassic building, 3 stories, and then huge windows to let the sunlight pass. And then the AI designs the building like that. Okay, so I think we are not even conscious of the impact AI will have in the real estate sector within the next 10 years. Okay, so I think we have exciting times ahead, and this is a good period to live in the real estate sector.
Thank you. Claire, can you touch on it as it applies to ESG as well? Yeah.
Yes, sure. I will cover these points briefly. Yeah. I think it's very promising to integrate qualitative information using some machine learning models, like other guests said about sentiment analysis. And actually now I know some companies, some data providers, they collect news and press, public news, and use their models to process those information and then output some risk metrics related to ESG. And this parts can be very promising. And another one is we can use more advanced models to forecast future data changes, like how we would forecast financial data, and we can use the more advanced models to forecast the ESG data and integrate that into the valuation. Yes.
Yeah, thank you. Yeah. So the final rounds of question is, I know we have the CFA, we have CFA charter holders amongst our speakers. I think so. I want you to tell us, how has the CFA designation helped your career thus far? So just touch on it. Then I will then go to Alejandro to give an advice to career starters that are on this call on one of the things that has also helped you. But for CFA charter holders on the call, can you tell us how the designation has helped your career? Yeah.
Me first?
Maciej. Yeah. Maciej, you can go. Yeah.
Okay, perfect. So my career advice is most of the entrepreneurs, most of the people that start a project, they fail not because they don't have the money or because the idea is bad. They fail because the application and the development of the idea is a very tough and long path to follow. So I have 2 advices. The first one, if you have a project in life, focus to it, stick to it, and work hard. And then the success is not one day you will wake up and you will have succeeded. So the success is something that you see when you look back at all the work you've done. So when you are as an entrepreneur or as a person that starts a career, you're always looking ahead and you're always looking to what's next. But then you will look back and then you will be happy about your work. So the success in life comes when you are hardworking and you focus always on your plan or on your work, and do not let anyone disturb you with, for example, in my case, lots of startups that raise huge amounts of capital. And they call this like, they said that we were not ambitious because we were not raising a lot of capital. And I was saying, okay, I don't need that amount of capital. And then some of these startups went bankrupt because they hired a lot of people. Then the economic downturn came and they couldn't pay the people. So follow your path, stick to the plan, hard work, focus. And then, as one of my first bosses said, this is like maybe too materialistic, but it's a very good advice. The first million, it takes a lot of time, a lot of effort to achieve the first million. The next millions, they come easily. Okay, so keep working. That's my advice.
Thank you. Yeah, Maciej, you can go. Yeah.
Yeah, so when it comes to the CFA designation, how to help me, I'll just outline 4 things. First of all, help me to choose my own path, because I was doing that at the beginning of my career, and enable me to gain more perspective and to actually better understand what field is more interesting for me and dive deeper into it. So in my case, it was quantitative models, market risk, derivatives, and that was part of the curriculum, and I was able to further explore that. The second thing would be like self-development, because I love to learn, and this enabled me to build strong, robust foundation of knowledge base in the field of investment management and financial analysis. And the third would be like external, because to other people, we cannot ignore that. This is like proving and projecting that you have a wide knowledge, good memory, and perseverance, and enough self-dedication to complete the program, given the time the time dedication necessary to complete that. And what is also often mentioned, a network, because we have numerous events like this one, but in many of the local societies, and it's worthwhile in terms of building both professional and private relationships.
Yeah, thank you. Yeah, Pedro, can you say something?
Yes, I agree with what Maciej also told us about the network. I would just add that I see the CFA charter holder as a stamp of quality that recruiters can trust. I mean, if these people is a CFA, it is because he has the knowledge of investment management, and that's a check. I don't need to confirm that, because if they have it, it's a check. So for me, it helped me a lot to change my career path also. And I think it's really important if you want to, if your job, if the market you want to be employed, if you think globally, you should have a CFA, because it's broadly accepted as a good stamp on your knowledge about investment management.
Yeah, thank you. Yeah, Clay, yeah, over to you.
Yes, thank you. I'm lucky enough to obtain the CFA charter holder quite early, as I became a charter holder even before I finished my master studies. And when I needed to search for my very first job in France, and CFA charter holder really helped me to find the first job, because in CFA France we have the mentoring program, and because of that I met my mentor Pierre. So at that time he gave me quite a lot of advices and connections, and thanks to him I really found my first job at Winfin. And also, as other guests mentioned about networking, in CFA society, you can meet a lot of other CFA charter holders, and it's a good way to broaden your connections with other professionals. Yes, thanks.
Yeah. All right, thank you, everyone. It's been a very insightful discussion and learning on the application of data science and investments. A big thank you to our esteemed panelists for sharing their expertise on this subject matter. And we will be sharing all of the, if you want to see the recording, we will have it as well on the CFA Society YouTube channel. It will be uploaded. And thank you all for joining. And want to say thank you once again and see you next time. Thank you, everyone. Yeah.
Thank you.
Thank you.
Thank you. Thank you very much.